Welcome back, everyone. Welcome to Venture Wisdom. This is the place we talk all things venture capital and private equity. If you were here for the last conversation with Yoni, it was a great walkthrough of the structure that one puts together for the venture fund. And those who are here for the first time, let me introduce you to Yoni Tuchman. He's the partner at DLA Piper, based in the West Coast, LA to be precise. A star fund lawyer for last 20 years. And he does everything funds. The way we talk everything funds, he does everything funds. So Yoni, thank you again for joining us for the conversation today.
Rakesh, amazing to be with you again. I had a ton of fun last time. I didn't want it to end, so I'm glad that you invited me back. Funds are us. That's what we're going to talk about. There's a lot to talk about.
Yeah, I know, particularly when you are more passionate about that subject, there's even more to talk about it. So I know you have that passion and would love to share that further with our listeners today. And as I understand today, we are talking more about the fund economics. And over to you, and let's see what you have from the economics perspective, how we talk about all the numbers, because venture is nothing but numbers. So over to you.
Yeah, and I would say also at the get-go that I when I see numbers, I like assume the fetal position, right? So you don't have to be a math person or a numbers person to really love fund economics, and I'm proof of that. That's why I went to law school, not business school. There's when I go through a summary of terms with a client to talk through, let's design this fund, let's build the terms of this fund to be both market but also suiting you and your investors. I had this joke when I get to the distribution waterfall, which is kind of in the middle of the summary of terms. I say, okay, this is why we're here. Like the last half hour of our conversation going through the investment period and the key person provision and the fundraising period and all these different terms, that was just to get us to this point. You're here for the distribution waterfall. That's the core of what we're here for. So it's a great topic to delve into.
Of course, I think that's the end result that everybody is looking for, right? How do you get to that point where you actually start distributing, and how do we really get to the real DPI back to the investors? So happy to talk about that.
So let's talk cash. Let's talk cash and venture funds. Okay, here's a couple things. There's two parts to this, right? There's two economic pieces to the fund, mainly. There's a distribution and there's the management fees. What's a fund? If you're sleeping in the middle of the night and I shake you awake and I say, what's a fund? You say 2 and 20. Those are the numbers that jump off your tongue. You don't have to think about it. 2 and 20. What do we mean by that? The 2% management fee and the 20% carry. Let's take the second thing first. Let's take the 20% carry. Let's take the distribution waterfall writ large. The end of the waterfall is at 20%. We have to get there, right? We have to get to that 20%. There's things that have to happen before we get our 20%. There's three questions to ask yourself thinking about distributions from a fund. Number one, what are you distributing? Number two, when are you distributing it? And number three, how are you distributing it? Okay? What is a venture fund distributing? It depends. What does it depend on? It depends if you're in the life of the fund or you're in liquidation. During the life of the fund, most fund agreements provide that the only thing the general partner is allowed to distribute, two things: cash is king, we know that, or liquid securities. How does a venture fund have liquid securities? Isn't there a limitation and a restriction on venture funds investing in public securities? At least more than 20% of the fund cannot be invested in non-qualifying VC investments. Non-qualifying would include public stock. Why would a fund be distributing public securities? Because one of their portfolio companies IPO'd. And now we're sitting on a rich vein of public stock, we can distribute that during the life of the fund because it's liquid, it's marketable. But if we're sitting on an illiquid security in a private company and we want to distribute that out, we can't. Based on the market terms for a venture fund, there will be restrictions on distributing illiquid securities during the life of the fund. Now, of course, I'm not sure I could think of a reason why you'd ever want to do that, or why the portfolio company would ever allow you to do that. But you also could not do that based on the terms of your fund agreement. In liquidation, though, if you're still sitting on illiquid shares of private companies and you're winding down your fund, at least according to the fund agreement, you could then distribute those out pro rata to your investors under the waterfall. So that's a little kind of a side point of what are you distributing, and the bottom line is during the fund's life, cash or marketable securities. In liquidation, theoretically at least, or contractually at least under your fund LPA, you can even distribute illiquid securities. Okay, that was question number one. What's distributed? Question number two, when do you make distributions? I tell clients there's really two models in the fund agreement. And I have a preference for one over the other. I'll give you the two models and you can tell me if you have a preference. Model number one is the LPA says the GP can make distribution whenever it wants. We'll decide. One sentence. The other provision is a version of this. The GP will cause the fund to make distribution of any excess cash sitting in the fund's bank account on an annual basis, subject to holding for reserves or whatnot. We'll kick out extra cash that we have on an annual basis, and within X number of days after an exit, we will make sure to send those proceeds out as well. 30 days, 60 days, whatever it is. My preference is number one, just flexibility. Think about it this way. Should investors care? Should investors care what the LPA says in terms of timing of distributions? Now the answer is sometimes they do, because they want to make sure that they're getting their cash as soon as available. But the counter to that is, what's in it for the general partner to sit on money? What benefit does the GP have to have distributable cash and have it sit in the fund's account? There's no benefit to the GP. Our interests are totally aligned. You want as much cash as soon as possible. We want to give you as much cash as soon as possible. It only helps our IRRs. And that's what we want. So the notion of contractually kind of tying the GP's hands to require the GP to look at the clock and look at the calendar and make sure that they're abiding by some, predetermined rules as to when distributions will be made, or even predetermined guidelines as to when distributions will be made, I prefer not to have it because, again, everyone's looking to do the same thing. Let me do my job, right, as a GP. So, again, is it a big deal? No. If you look at most, big, institutional private equity funds, are they going to have version 1? The GP will make distributions whenever it wants, or version 2, a more kind of rigorous time frame within which distributions are required to be made? You'll see version 2 more often than version 1.
That's what I thought.
Yeah. But for venture funds, for a $100 million fund, for a $200 million fund, I much prefer version 1. I prefer version 1 for a $1 billion PE fund too, but
yeah, because I would not keep the money in the account. The common sense says that it only hurts my IRR when I have to show the returns back to the investors, right? But if I have to build or consider 2 points here which come to my mind, and if I may ask, do these terms change based on the type of LPs that I have? Say a large institutional LP versus the family offices versus the HNI kind of LPs? Or does it change based on whether I'm a regular venture type of fund versus a buyout, LBO, MBO, private equity fund?
Yeah, I think what drives it is the nature of the investor. The asset class shouldn't make any difference, right? If a fund has cash, everybody wants it, right? But it's the more institutional, larger LPs that have checklists, right? They have checklists when they're looking at your fund, and they have lawyers who have their own checklists. And so they go. I'm being like literal. They're going through a literal checklist, and they have 30 or 40 things they're looking for in your fund documents. And one of them is going to say timing of distribution, and it's going to say, is the fund required to make distributions on an annual basis and to get out, to distribute any, proceeds of an exit within a certain period of time. And some associate at a law firm somewhere is checking a box, yes or no, right? And so they're gonna be like, oh, the answer is no. Okay, let's make that into a yes. Let's raise that as a comment. I'll tell you where this also comes up. Side point, tangent. Okay, detour here. The fund calls capital. They make a capital call for an investment, and then the investment falls through at last minute. What do? Is there a contractual obligation requirement in the fund docs to return that capital call within X number of days? Or can the GP say, look, I know I called the money for a specific purpose. The purpose is no longer true, but rather than wire the money back and then call it back from you, in a short term, it's easier for me to just sit on it. Is it bad for my IRR? Yeah, but it's not worth the hassle, and it's not that bad for my IRR because it's not going to be a lot of time, or it's not a lot of money, or both. Is there a requirement in the fund documents to return unused contributions? It's the same issue. It's the same comment in the same checklist that an associated law firm is going through when they review your fund. It literally said, called capital that's not used, is it required to be returned within X number of days? Yes or no? If it's no, well, okay, let's make a comment. Let's change that to yes. So,
Sure.
two ways that comes up. So we talked about distribution. We talked about what you're distributing, and we talked about different options as to when you make distributions. Okay?
Yeah, I have one more question connected to the distribution part as well. Is how do you really build the terms around the recycling / reinvestment of the money, and how does that impact the distribution?
Yeah. Well, that's very good question. So recycling of credits. There's two. When I think of recycling, I think of it in two ways. I think of it as internal recycling and external recycling. So let's just define the term so that we all know, we're all on the same page. That's what we mean when we say the word recycling, because I guess it can mean different things to different people. So I think of it in those two ways. External recycling is where the fund actually makes a distribution and then has the right to call that back for a further investment.
Mm-hmm.
Internal recycling means we're doing that same thing, but we're not round tripping the money. We're just keeping the money in the fund, and instead of distributing it and calling it back, we're using it again.
Understood.
There shouldn't be any difference between those two. I mean, there's a practical difference, right? Because in one case, there's wires going out and coming back, and in the other case, there's not. And internal recycling, the way it works is it's treated as if it's distributed and recalled at the time that it's applied within the fund or reapplied within the fund. So they're really both accomplishing the same thing in really the same way, except there's a facial difference where there's actually money moving in external recycling, and there's no money going out and coming back in internal recycling, but it's treated the same way. So with that in mind, how does recycling impact distributions? So I think we have to talk about the third question and the last question, right? That third leg of this distribution stool, not what is distributed, not when is it distributed, but how is it distributed? And then let's come back to your question about recycling, because recycling is going to impact this last question, I think, of how does that factor into the math in a distribution waterfall?
Mm-hmm.
Does that make sense?
Yeah, absolutely.
Okay, let's talk about this is really why we're here, right? How does money go out of a fund? There's three broad answers to this. There's three options broadly. They go in the order of simplicity to complexity. And the good news is, for a venture fund, in my experience, 9 times out of 10, it is the most simple option. 9 times out of 10 for a venture fund, there's 2 steps to your distribution waterfall. Number 1, return all capital. Number 2, 80-20 split. In a venture fund, in the US venture fund at least, it's a little different overseas. In the US venture fund, I'm hard pressed to find a fund that pays a preferred return. I also rarely see, but rarely see a fund that returns at the first step of the waterfall anything less than 100% of the dollars that have been called.
Mm-hmm.
So the starting point for a venture fund is 2 steps, what we call a European waterfall, which means return every dollar you called. Not every dollar that's committed. Sometimes people have a misconception that if I have a $100 million fund, I don't get carry till I return $100 million. That's not true. If I have a $100 million fund, but I called $30 million so far and I have an exit, I have to return $30 million, not $100 million. So in that venture fund, you return all capital most of the time in most funds. And then after that, every dollar of profit split 80-20, typically. That's like 9 times out of 10 in my experience.
But that's an interesting one, and I'm sure we'll be covering that in the carry conversation as we move forward. But then, if you are considering that part of distributing the profits / carry during the distribution itself, and the mathematics change towards the later part of the fund's life cycle, how is that adjusted? So we did the carry calculation during the distribution in the middle of the fund's life, right? Mm-hmm. But and that carry calculation is done on the profits until that point of time. But right. The profit overall, with the total committed capital, may change downwards towards the later part of the fund's life. So how is that adjustment made when we get to that part of the of the fund life cycle?
Okay, got it. So let's take an example. You have a $100 million fund and you called $30 million and you turn that $30 million into, $31 million, okay? So what do? You distribute, so you have $31 million to distribute. So you distribute the $30 million, that goes back to the investors who put the $30 million in. If you put 1% of the fund in, you get 1% of that as the GP, whatever. Everybody gets their money back. Then you have $1 million profit. How is that distributed? It's distributed 80-20. So the LP, let's say there's one LP and one GP. The LP gets 800 grand and the GP takes 200 grand of carry. Now, a year later, you have another exit. You don't have an exit. A year later, you have a loss, right? Yeah, so now you've lost money. You've lost money. And then a year after that, 2 years after the first distribution, you have another exit, okay? So you're totally right. You're looking backwards holistically from day one. And it's possible when you have your second exit, that second exit may be profitable, right? But it could be you're not going to get a penny of carry on that second exit because you have to go and make the investors whole for the money that you lost in that second deal, right? Just again, 3 deals, for example. The first one was profitable and you got carry. The second was a total loss and the third was profitable. Depending on how much money you lost of your investor in the second deal that was a loss, you're using the profits from the third deal to return that loss from the second deal, and you're not going to get carry from it. Now, does that make sense?
Yep.
Now what you were asking, I know, is even a step further. Let's say there's not enough profit from deals. Let's say deal 1 was a big success, you took carry, and there were 2 other deals in the portfolio, you lost them both. And then the fund is over. Now what?
Yeah.
Took too much carry. You took too much carry. And that's where you get into a clawback situation. That's why every venture fund has a clawback provision for exactly this scenario. You did a great job in the beginning, but you didn't do a great job in the end. Strong start, weak finish. You took too much carry. At the time you took it, it was totally correct to take. But in hindsight, hindsight's always 20/20, you took too much. So you have to give back the extra carry that you would not have been entitled to had all deals been realized at the same time, putting aside, drowning out that noise that was introduced into the math because of different timings of winners and losers. If everything were to happen simultaneously, would you have been entitled to carry? Or would you have been entitled to as much carry as you actually took? Right? If the answer to either of those questions is no, you would not have been entitled to any carry, or yeah, you would have gotten some carry, but not as much as you actually took because you took it early in the fund's life. You have to give back the extra. We could do a podcast about that, the clawback.
Yeah.
The clawback, there's a lot to talk about in the clawback, right? Who's on the hook? How is it calculated? Bear in mind, the GP has paid taxes on that carry. I mean, that's got to be taken into account. I'm not giving back money to the investor that already paid to Uncle Sam. How do you calculate the taxes on that? So can I return in kind? There has to be cash. What's backstopping that? What's the credit-worthy person or entity that's backstopping, if so, if there is such a thing? So there's a lot to talk about. But that's the answer to your question, Rakesh, is you're right. The math can get out of whack over time because the fund is disposing of investments and calling capital over a number of years. And if that happens, we have to true it up at the end. Yeah. So that's how that would work.
Interesting. So, yeah, go ahead, please.
No, I was just say so there's three different paradigms for how distributions are made. But the good news is the easiest one is the right one in terms of what the market would suggest or be happy with for a venture fund. And that is, again, that's that two-step waterfall. European waterfall, meaning first step is to return all capital, no preferred return. If there's no preferred return, there's no catch-up, and we can talk about what those things are. But if there's no pref, there's no catch-up, and then you go straight to your split. And it's typically 80-20. Remember, I woke you in the middle of the night, I said, what's a fund? You said, groggy, like reaching for your glasses, you're like 2 and 20. This is the 20, right? The 20% profit share. In some funds, you have a lower profit share or carried interest split. So what would be an example of a fund like that where the GP is taking less than 20% of the profits? A fund of funds. We have plenty of clients that have fund a venture fund. They're fund of funds that invest in venture funds. Their economics do not look like the economics of the underlying venture funds that they're investing in. The underlying venture fund is 20% carry. The fund of funds carry is probably 10%. But putting aside a fund of funds, most funds, VC or PE, are still charging 20%. Let me give you a couple ideas about how even venture funds have more complicated waterfalls than the simple two-step waterfall I described.
Yeah. Now, I think one of the examples for that I can think of is a hybrid fund, right? Who's doing both the fund investments as well as the direct investments, for that matter. That's one that comes to my mind. I'm sure there are many more that you would have.
Yeah, I mean, hybrid funds is a pet peeve of mine. I got to tell you, it's a pet peeve. I've had, often conversations about what is a hybrid fund? Does it make sense to have a hybrid fund, or you really have two different funds? It's sort of like pick a lane. Like, what are you really doing here? And I'm not saying hybrid funds are bad. We have clients that are hybrid funds, but the question that you have to work through in that case is, are you mainly a VC fund that's also doing some fund of funds investing? Or are you the opposite? Are you really a fund of funds that's also going to do some direct deals? Because if you're really a hybrid fund, if you're really doing 50% of each, so half of my fund is investing in companies half of my fund is investing in venture funds, then it's very hard to get, well, I would say very hard. You have to decide, you have to be smart and figure out which economic model are you choosing here. And maybe that's actually worth, well, so wait, we already talked about how a fund of funds is different than a venture fund. Because a venture fund charges 20% carry, a fund of funds charges 10% carry, just speaking generally. You're a hybrid fund, which do you charge? So you have 3 or 4 options. Let's think about them. One option is, I'm not really a hybrid fund, I'm really a venture fund, but I also may invest something into other funds. So I'm a 20% fund, right? I'm charging 20% because a small amount of my fund, relatively maybe invest in other funds, but I'm still a venture fund at my core, so I'm charging a 20% carry. Or the flip side, at my core, I'm a fund of funds, so my carry is 10%, but I may also do some direct deals. I'm not gonna be greedy, and I'm not gonna try to get more out of it. Those are just to juice everyone's returns if I have good opportunities, but I'm really essentially at my core a fund of funds, so I have a 10% carry. So those are the two of the 4 options. I think there's 4. Let's see if I'm right. The other model in the middle would be the most complicated, right? Where you literally bifurcate within your single fund. You have both a pool of fund of funds assets and a pool of venture fund assets, and you allocate the profits or the revenues from the different pools differently. So you literally
in this case, I think this connects to what we had in our previous conversation around the structures. Would this kind of arrangement or the thesis suggest that you have 2 different vehicles to invest from, or you do it from one single vehicle?
That's exactly the question. That's exactly the question. I often coach clients who are thinking of hybrid funds. Well, this is how I coach them. Like, let's talk it out. I don't know what's right for you. Let's talk it out. So I'll lay out these 5. Okay, let's go through 5 options. Okay, I know this wasn't our agenda for the call, but let's get into it. Okay, you have a hybrid fund in mind. How do you design this thing? So option number 1, you're not really a hybrid fund. Correct your thinking. You're really a venture fund doing some fund of funds deals. Structure this as a venture fund. Option number 2, correct your thinking. You're not really a hybrid fund. You're trying to sound fancy. You're really a fund of funds who may do some direct deals. Give yourself, and your investors fund of funds economics. Option 3, you literally are a hybrid fund. Roughly half of your fund is going to go into direct deals. Roughly half of your fund is going into fund of funds. Someone would lose out, right, if you were to just have venture fund economics, namely, you're charging 20% carry on everything, so your investors are losing out because half of their deals in your fund are really going into other funds, but you're still charging the full 20%. If you think of yourself as just the fund of funds and you're charging 10%, you're losing out as a GP. You're leaving money on the table because you really should be charging more for the direct deals, the 20%. And then so what you can have is the third option. You have 2 waterfalls. I charge you 20% on the direct deals. I charge you 10% on the fund of funds deals. 2 different models within the same vehicle. Is there a simpler way to do that? That's option number 4. Option number 4 is have 1 waterfall and just, instead of having a 10% or a 20%, have a 15%, right? Just kind of average this out. Like, we're doing both. So it's all going to kind of come out in the wash. Let's not have the complexity of 2 different waterfalls within one vehicle. Let's just pick a number. Maybe it's 15% because that's just like smack dab in the middle between the 10 and the 20. Or maybe you have a model. You've modeled out how much of your fund. It's not going to be 50-50. Maybe you have a waterfall that's 17.5%. Instead of 20 or instead of 10. Maybe it's 12.5, right? So those are really, that's really the other option, which I like. And then so again, should we just recap? So we're losing anyone? You have a hybrid fund. Option number 1 is you're not really a hybrid fund. Don't fool yourself. You're a venture fund, 20%. Option number 2, you're not really a hybrid fund. Don't fool yourself. You're a fund of funds, 10%. Option number 3, you're truly a hybrid fund. 2 different waterfalls within the same vehicle. Direct deals, 20%. Fund of funds deals, 10%. Option number 4, you really are a hybrid fund. You're not fooling yourself. You really are. But you don't want the complexity of option number 3 where you have 2 different waterfalls and you have to allocate everything depending on exactly where it's coming from, direct or indirect deal. Just average this out. Have one waterfall with a 15% or a 12.5% or a 17.5% carry, depending on how you're kind of targeting your portfolio makeup. That's option number 4. And option number 5, Rakesh, is what you said a few minutes ago.
Had 2 different vehicles.
2 different funds. Come on, let's not make this complicated. 2 different funds. People who want to invest in direct deal, they'll come into that. People who only want fund of funds, they'll come into that.
That will again take us back to the older conversation. So should you have a feeder fund that feeds into 2 different funds that you're doing, or have them 2 separately?
Love this.
I know I'm going away from economics.
I know. I know. We started with this is how this should go. We started with one topic, then we veered to another topic. Now we're going down this. It's not a rabbit hole because it's a juicy good thing, but like it's great. So now we had these 5 options because you wanted to fund the funds. We have 5 different options, and now we're within option 5, which is do 2 different funds. So now you're asking another good question. Okay, you're doing 2 different funds. How? Right? Are they literally 2 different funds with 2 different sets of documents, 2 different sets of subscription booklets, and people have to subscribe to both if they want both, or they can choose one or the other? Or what's the other option? It could be that, plus you build on this kind of feeder vehicle that's allocated in whatever percentage you say to both. So you're telling
me bring back the same complexity that when you are doing an arrangement with the LPs for the feeder fund. What carry do you calculate? What waterfall do you follow there?
Okay, so let's play that out for folks. So we're setting on option number 5. You're doing 2 separate vehicles, a venture fund and a fund of venture funds. Okay, you should have the ability that LPs can come in and choose. Right? When I was a kid, I liked to choose your own adventure stories. If you want to go into the dark attic, turn to page 36. If you want to climb back down the stairs and run away, right? Choose your own adventure, LP. You want to come into a venture fund alone? Great. Fund of funds alone? Great. You want to come into both? Fill out 2 sub books. You decide how much you allocate to 2 funds. Then we can offer another option. By the way, I like that option. It just keeps it simple. And I don't know if I mentioned this in the last talk we had. I was trained on the KISS method of working, of keep it simple, stupid. So I like that. 2 vehicles, just keep it simple. But if you wanted to have another option for investors, so they don't have to fill out 2 sets of docs and keep track of 2 separate allocations that they've made, and you want to simplify it on their front, which they'll appreciate, you could form 1 feeder fund. So now you have 3 funds: the venture fund, the fund of venture funds, and a feeder fund. And you can have the feeder fund invest as a limited partner into your venture fund and as a limited partner into your fund of fund. And so the LP who wants exposure to both just signs 1 set of docs. They have 1 allocation they're keeping track of. They have 1 K1, right? And it's simpler for them. What do the economics look like? Is that what you're asking now in that feeder fund? And the good thing is they're really simple, because the GP of this feeder fund is the same GP of the venture fund and the same GP of the fund of funds. So the GP is getting its economics not at the level of the feeder fund, but at the 2 funds below. So the feeder fund is nothing more than a limited partner in these 2 funds beneath it, the venture and the fund of venture funds. And so the economics that flow from those 2 underlying funds to the feeder, they're just distributed pro rata.
Makes sense.
Because the carry was taken down below. So you can keep that top vehicle, the feeder vehicle, very elegant and very straightforward. There's no waterfall there, just pro rata. So that's how I would do that.
Yeah,
that's how that
makes sense. I think that's. I'm glad we are having this conversation because it kind of clears a lot of thoughts around that whole complexity of what exactly should be my waterfall model that I'm planning to do. I know that not everybody is doing the hybrid funds. We brought it up because we are discussing more holistic side of the economics from the conversation point of view. But otherwise, it's straightforward, as you said earlier.
Yeah. Let's hit a few other things. Let's just take a couple minutes and talk about a few other ways that a venture fund's waterfall can be more complex. Putting aside if it has another kind of fund to funds component, like we were just discussing, like a hybrid component. Straight venture fund. Where would it ever be more complicated than return all capital and 20%, 80-20 split? Here's a couple ideas. If you want to differentiate yourself from the rest of your peers and you want to offer some preferred return, it would only help, right? It doesn't have to be an 8% preferred return. It could be a 4% preferred return. But something that the LPs know that I'm just not returning your dollars and I'm getting 20% of every dollar of profit after. You're going to have to get some profit before I start getting profit. I don't know. I've seen it before, but very rarely. I don't know that I have any clients now that have that. I don't think I do. That's one option, though. You could also do, even without a preferred return, you can have a more GP-friendly waterfall in your first step. Now, I was assuming you have a European waterfall. Well, you return every dollar that you called. But you don't have to do that. You can have an American waterfall and return a subset of the dollars that you called in the first step of the waterfall, and then jump to 80-20 split even then. It increases the likelihood that there's a clawback risk that you raised earlier, because when you're returning less dollars up front, you're increasing the likelihood that you end up taking too much carry. Because when you return less dollars up front or fewer dollars up front, that means you're taking carry sooner and earlier. And anytime you're advancing or accelerating your timeline for getting carry, it just puts more pressure that you may lose money later because there's more period of time to lose money, which would throw the distributions out of whack and result in a clawback. But you could, and we have some venture fund clients that have a waterfall that's more GP friendly than the two-step waterfall I described. So in other words, you can make your waterfall a little more LP friendly by introducing a preferred return. If you do that, you're going to want to also have a catch-up, which we can talk about.
Yeah.
But you could also go the other way, the other direction, and make your waterfall more GP friendly. How do you do that in a two-step waterfall? You're returning even less than what you called in the first step. That's what we call an American waterfall. There's different American waterfalls. But the bottom line is you're returning not all the money you called. You're returning money that you called for investments that have been disposed of, investments that have been written off, and some fees. Perfect.
So yeah, thanks, Yoni. I think this brings a lot of clarity in terms of the first part of the economics that we wanted to discuss, how the distribution works. I know that we started with the simple side of it, and we brought in some more complex models around it and complex scenarios around it, and we can go deeper and deeper and deeper into it. As you always say, it's a rabbit hole. You can keep going down it, and I'm sure we would do that again at some point of time. But for this clarity, this conversation today, again, I appreciate your time. Thank you so much. I'm sure our audience have enjoyed and learned a lot from this conversation and would look forward to our next one too.
So it's great, Rakesh. Thank you so much. It was so much fun to talk to you.
It's always a pleasure. Thank you, Yoni.
Bye.